Mortgage Talk with Mark. And if you're at all familiar with this show, generally I have a guest on, and I always like to have a guest on for lots of reasons. One, because I don't want to talk for 26 minutes, but my guest last night had to cancel on me for a family emergency, so I wanted to come on today and going solo. So I sat down and wrote some questions, the very common questions that I get in the mortgage space. After 40 years, I've talked to thousands of people and have uh, put together a couple things that I want to review today with everybody to kind of give them an update what's going on in the mortgage world, but also some of the fundamentals. Because for most people, buying a home is going to be the most important or largest transaction or investment they're ever going to make. So I want to talk briefly about the process, because the process hasn't changed a whole lot in the last 40 years, but there's details of people that want, if you're going to be thinking about buying a home this year, that you want to kind of pay attention. So I want to talk about from the beginning of the idea of buying a property all the way through closing real quick. Give me 8 or 10 minutes on that. Then we'll talk about some other things as well. But most people, when they're thinking about buying a home, do one of two things. They go on Zillow or some online real estate platform and look for homes. They look for neighborhoods possibly, or styles of property, or price points, or whatnot. Or they go around, they drive around neighborhoods, and they go to open houses, which are two great ways to start, because you want to get a feel for what you're looking for. And so, but the fact of the matter is, I can't tell you how many times every week where I'm talking to prospects who've been referred to me to get a mortgage loan, and the price point they're looking at is really not inside their budget. Unfortunately, because prices are a little high, taxes are high, rates are still a little high. So you want to be very clear about what your budget is. Is it $2,500 a month, or is it $6,500 a month as far as your mortgage payment? And that's all in, including taxes, insurance, any HOA dues, et cetera, et cetera. Make sure you're very clear about that, or have a flexibility of certain price points. As an example, I just bought a new truck a couple months ago. Well, the truck I really liked was going to be around $1,600 a month. That was not in that was not in my budget. So I told the salesperson, I said, I need $1,000 or lower. So I had to change my decision on the kind of truck I was going to buy, which is nice. There's no complaints about it, but just wasn't exactly what I wanted from the very get-go. So identify what your budget is, and then be prepared to make an application. And when I mean that, get pre-approved. Make sure that the lender is okay with what your budget is as well. And most of the time it will be, but everything we do on the lending side is pretty much a 2-year look back. We're going to look back at your income stream, your employment history, and then we're also going to run your credit history. There's basically 3 C's to an application. There's your capacity to make the loan, to pay the loan back, which is your income. Are you self-employed? Do you have a W-2? Do you have more than one job? Do you have seasonal work? So we're going to address all those factors. Number 2 is your credit. And we usually use what they call a credit score, which is a whole other conversation around how that works. But everybody, for the most part, has 3 different scores. Lenders will use the middle score. And there's ways to correct that or improve that over the time. So that's why you want to get that done as soon as possible. Get pre-approved sooner. And that's sometimes within several months of buying a home. You know, I've got a couple that came in yesterday, and they're not buying a home until next year, but they're smart because they're getting their ducks in a row, if you will. So we're going to look at credit, number 2. And then number 3 is cash to close. Now, the more you put down, typically the better deal you're going to get on your interest rates and some programs that may be available to you that wouldn't be to others. Or if cash is an issue, if you're a first-time buyer, there's going to be some alternative sources of funds through grants through the state of Texas that you could access. It'll help you buy a property. So those are the first things you want to do. You want to look at your budget, and then you want to get pre-approved. And I recommend you get pre-approved, or at least talk to 3 different lenders, one being a broker like myself. And I'm going to talk about the difference between a broker and a mortgage banker or a commercial bank in just a few minutes. But maybe talk to 3 different people. The second one, the other party that you want to interview strongly is a realtor. You can obviously access properties online easily, but you really want to hire a very qualified agent to help you in negotiation, because the negotiation in this market is critical, because there's so many what I call advantages or opportunities in this market that we may not have seen a few years ago, as far as price points, Prices have actually come down, and there's lots of inventory on the market right now, a lot of homes for sale. So a good realtor who has a lot of experience in maybe the area that you want to live, whether it be South Austin or Kyle Buda or Westlake or Liberty Hill for that matter. Find an agent who knows that market very strongly, maybe even lives maybe not in the neighborhood, but that general area, who's done a lot of business up there. And after 40 years, I know hundreds of very qualified agents. And if you have any questions around that, I can maybe help you identify somebody good for you. So that's number two, is interview a strong agent, because they're going to make you sign what they call a buyer agreement, which means you are agreeing to work with them through this transaction. So you want to make sure that that person is the right person. Same thing on the loan side. Now you can change lenders, but the buyer agreement sort of makes it firm that you're decided to work with that particular agent. The other thing we want to talk about is the process itself. You contract on a home, and that's again the negotiation part. If there's lots of ways for the seller to help you as far as buy downs on your interest rate or paying your closing cost, things like that will help you, get in the property. I'm doing a loan now, closing next week, and he's putting down 5%, and the seller paid $25,000 for a buy down and closing cost for him. So all he had to put down was his 5%, and he got a rate in the fours initially because the seller was in a hurry or some sort of reason that he wanted to sell quickly. So he was able to give back quite a bit of money to my buyer, my client, to help him do that. So that's really important. The negotiation piece is huge, because again, you could leave thousands, if not more than that, on the table if it's not done correctly. So those are two key items: a good lender and a good realtor. And then the process is basically, once the contracts comes to me, then my job actually begins. By then we would have talked about some different options for you. We would have talked about some, to make sure you're comfortable with the mortgage payment. And each property is a little bit different. That's the thing about real estate, in certainly in Texas. Property taxes vary from area to area quite a bit, even from neighborhood to neighborhood. So you want to identify exactly kind of what you're buying up front and get those numbers, initially, so you'll be comfortable going in, that there's no surprises. We don't like surprises. So that's number one. And number two is, at that point, we'll have collected the financials, and typically that's going to be W-2s, pay stubs, bank statements. If you're here on a work visa, we'll get a copy of your work visa or Social Security card or driver's license, some basic things like that. We'll have done that up front to get you pre-approved. And then the loan goes into process. And processing is not really difficult. It's just very, very detailed, because lenders these days, lenders have always been conservative in some respects. Sometimes some lenders are a little easier to work with than others. Some are a little more, maybe have better rates, but their paperwork is, they want to cross every T and every I, dot every I. And I look at it as kind of a puzzle, that a mortgage loan is a puzzle, and there's lots of pieces to it. And each puzzle piece has to fit just right to make the puzzle, to make the loan. And so it can be somewhat of a frustrating experience, because lenders are going to ask you for lots of things. As an example, if you've transferred money to an account and you have large deposit, they're going to want to source that money. Where'd that money come from? If you're going to get a gift from a family member, there's some gift documentation we're going to require. There's, again, transfer. They're going to paper trail the money. They're big on paper trailing money. And also, you're going to want to look for, make sure if you're seasonal or if you're hourly, that your hours compute to what you're saying is going to be your income. Like right now, I'm doing a loan for a young lady, and she works for a dental company, and her verification of employment was not exactly what she's earning. So we had a little challenge there. We worked through it, but make sure that if you tell us you work 30 hours a week, that you work 30 hours a week. Or if you work 40 hours a week, make sure that that's going to compute to what you give us up front. So those little details like that are huge when it comes to getting qualified. And also your credit. I had a young man come in not long ago, and his scores were down in the 600s. Well, that wasn't really workable. I mean, he could qualify, but the rate was not very good. So what we did, we took a couple months to help him improve his credit scores from around 605 to about a 660. So he's going to get a much better financing option if you can get your credit scores up. And again, that's a whole nother class that we can do on credit scoring because it's somewhat complicated in a way because it's sort of a mystery. And I don't know all the mystery, but I know enough of it to help most people. And then once you make an application, we disclose the loan. There's lots of governmental forms that have to be signed that the lenders require, and they're standard forms, what they're called promulgated forms, similar to a real estate contract. You can't just white things out and make corrections and initial it. These are legal forms, and same thing with disclosures. They have to be signed, and then we can move the loan into process and then underwriting. Underwriting is where the company, in my case, I work with lots of different lenders out there. I don't just work with one. And the reason I do that is because lenders around the country have what I call appetites for types of loans. Like some lenders they want VA loans. That's their hot button. They want to just work with veterans. So I take my veteran loans to one or two different companies. Typically because of price, they go for very good rates for veterans, but they don't care so much about FHA loans or subprime loans, things like that. And some lenders want large down payments with really high credit scores. They're going to give really good rates, but that's the kind of profile they're looking for. So once we identify your profile and your qualification, then I place the loan with with a lender who's going to give you the best deal. And I'm paid by the lender, not you. I don't charge a fee to the buyer. Wherever I place the loan, I get paid a commission to do the work. So that's how that works on my end. Now we're going to talk about a little bit options on that here in a second, but that's what I do. And then once we disclose, then we can order the appraisal and we can submit the loan for approval. The underwriter's job is to review all the things that go into making the loan to qualify for the loan. And then she says, well, Mark, you missed this or you missed that. We were going to approve the loan based on getting verifications of this or that. Like the lady who works for a dental company, she's had 4 jobs in the last 2 years. She's worked for 4 different companies of dentists in the last 4 years. So we had to verify her income through a written verification for all 4 companies. So sometimes there's layers and layers of what they call guidelines or underwriting conditions, et cetera, et cetera. So it can be sort of tedious and detailed. It's not real difficult. It can be frustrating. I'll just leave it at that. And then once the underwriter reviews the file, likes the profile of the borrower, wants to make this loan, then they approve it with certain conditions. And then once we meet those conditions, then they issue what they call a clear to close, which means you're done. Like I had a loan clear to close last night. And the buyers are ecstatic because they've met all the conditions and they're ready to close next week. And so once that's done, once we get what we call the CTC, even before that, we'll have issued you an ICD or initial closing disclosure, which is basically a summary of the initial estimate that we gave you up front. And the ICD is more of a formal estimate. It's not exact yet, but it's going to be very, very close to the final cost of the mortgage itself, the tax escrows, any HOA dues, any HOA transfer fees, things like that, your insurance costs. And it'll give you the final payment, and it'll give you the final estimate to close as far as dollars. And so that's the first thing you'll have to sign at least 3 days prior to closing. And then the closing date is what we call the celebration date, where you meet with the title company. The title company is the conduit or the fiduciary to handle all the funds. They'll have talked to you way before you end up at their office, but that's where you typically close, is at a title company here in Austin. Or they'll maybe do a mobile notary. If you can't make it, they may come out to your office or your work or your home and close there with a mobile notary. That's another option, but most people go to an office, to either an attorney's office or a title company. They sign all the forms. We usually have a little celebration, maybe some champagne, and then you get your keys, the loan funds, and the house is yours. That's kind of the process of how that works. Prior to that, you would have gone maybe get a final inspection done on the property to make sure, what they call a final walkthrough, to make sure the property's in the condition that the seller had promised. And maybe if there's repairs that were required by the lender or negotiated repairs by you. Like I've got one client now who's the seller has promised to put on a new roof because the roof is shot. So they had to apply through the insurance company to do that. That's been approved, but the roof is not on yet. But obviously we have to require that the roof be done before closing. So just because you've agreed to it, the lender's going to say, yeah, that's great, but we're going to do a final inspection on that ourselves to make sure that the roof is done. So that's kind of how that process works. So again, it usually takes, I like to see around 30 days from contract to close. We can usually do it faster than that. But depending, there's different things that pop up, and we want to make sure we have plenty of time. So if you can negotiate a 30-day contract, that's going to be plenty of time for most loans to go through. Now, let's talk about sourcing the funds. When I think sourcing the funds, I mean the distinction or the difference between a mortgage broker and a mortgage banker or a commercial bank. There's three basic channels of loans. There's your traditional, most people say, I want to go to my bank or credit union would be, maybe it's Chase Bank or Wells Fargo. They all do mortgage loans. UFCU, credit unions, a lot of credit unions also provide residential mortgages. Then there's large, these are called commercial loans. I mean, commercial banks, not some commercial loans, or residential loans inside a commercial bank. And you're usually dealing with a loan officer inside the bank who's an employee of the bank. And the bank will offer whatever products they offer because that's what they have. And then aside from that is what they call mortgage bankers. A mortgage banker is not a commercial bank. They don't have their own funds. They don't, you can't get a car loan or a consumer loan through a mortgage bank. You can only get a mortgage loan, and they specialize in that. And I've worked for a lot of them over the years. There's certain advantages of that, but typically the downside of that, in my opinion, having done this for 40 years, is their rates are going to be a little bit high. Because they need to make a little bit more money to pay all the people in the bank, if you will, not just the person making the loan. Where a mortgage broker is independent, and a mortgage bank will have a certain product mix, which is pretty standard. They'll have conventional financing, they'll have FHA, they'll have VA, USDA. They may have some alternative loan options as well, but everything is going to be in-house. So you're dealing with one company, one transaction. But they're somewhat limited on how they can negotiate their rates because their rates are going to be pretty much set by the management. Whereas a mortgage broker, I'm an independent. I have an office here in Austin, a small office, and I have relationships with lots of different lenders around the country. And again, we talked about that just a minute ago. Why I do that, because I can offer typically much better interest rates because I negotiate the deal myself. I don't work for one company that tells me what I can offer. I work for the borrower to shop for the mortgage. Now, having said that, sometimes big banks or credit unions, but usually the commercial banks, on the higher end properties, $1 million plus loan amounts, I should say, may offer a better deal to their preferred clients. If you've got a bunch of money with, Wells Fargo as an example, then Wells Fargo is going to be enticed to keep your business. So they're going to discount their mortgage rates typically for people who have lots of money with their institution. And I mean lots, meaning $500,000 or $1 million, something in that range, where they're saying, yeah, well, this is a good client. We don't want to let him go to anybody else. So we're going to give him a better deal. Sometimes that's the case, and that's going to be a better deal than I can offer because you don't have accounts with me. So that's something to consider. Shop it out. Shop with a bank, shop with a mortgage banker, and shop with a broker. That's what I recommend. I even wrote a consumer guide called The Truth in Lending, where I show you people what questions to ask, how lenders make their money, the different types of channels, and explain a little more in detail around this subject. So if you want that report, you can call me at 512-789-6967, or you can just email me at mark@markharrison.com, and I'll return that. Be happy to share that information with you because it is a big decision. I don't care. In Austin, Texas, I think our average sales price is $400,000 or $500,000. So it's a lot bigger than when I got in the business when the average loan amount was $70,000. So keep that in mind. Now, I want to talk about another type of loan that is starting to be talked about a lot more now than it was a few years ago. It's called a HELOC. A HELOC is a home equity line of credit. It's typically a second lien. On one of my properties, I have a HELOC. Now, I don't make HELOC loans personally. It's usually a bank product. Like mine personally is with Bank of America. Now, they're not the only source, but when I shopped it out for my own personal use, had the best deal for me was Bank of America. Now, there's a lot of credit unions provide HELOCs. And the purpose of a HELOC typically is a line of credit. In other words, if you qualify, where it maybe comes into play right now is people who have equity in their homes and they want to access that equity, But let's say their interest rate on their mortgage, let's assume you have a mortgage at 3% or 4% that you made several years ago when the rates were very low, but you want to access some equity for different reasons. It could be college tuition, it could be, to buy a new truck, it could be any reason you want. It's your money, and we can't tell you what to do with your money. And you want to access that money. It may be best done through a HELOC, and here's why. This is what I did years ago on mine. Was we had quite a bit of equity in one property. We had an underlying lien at 3%. So we didn't want to touch that. We didn't want to pay that off to access our equity. Wanted to keep that, and we applied for a HELOC loan or a line of credit. And so the reason we did that was to make an investment in some property we wanted to buy. So we took some equity from one home, and we put it down on another home. Now, the advantage of a HELOC is there's very few closing costs, virtually none. Matter of fact, I don't think they even charge any closing costs. So that's number one. Now, the rates are typically higher, and they're usually an adjustable rate. Keep that in mind. But one of the advantages of it's interest only. So although our HELOC rate right now, as we speak, is 8%, we pay just the interest on the loan for 10 years. After 10 years, it'll amortize into a full-time 20-year amortized loan. So you only have the access of the HELOC for about 10 years. But it acts as a credit card. We've used it, my wife and I have paid it off, and then we can use it again. It's available to you as a line of credit. You can write checks against it to pay for different reasons. You may want to consolidate some credit cards at 25% or whatever your credit card is. If you have $30,000 in credit cards, you may want to get a HELOC to pay those things off at 8%, which is going to save you hundreds of dollars a month. So there's lots of reasons to get a HELOC. And I have this question, not every day, but almost every day, about accessing funds. And a lot of times I'll refer them to a bank like a Frost Bank or other credit unions who have excellent HELOC options. So that's something to consider. Now, but finally, I've got a few minutes here, and I want to talk about another subject around how to not only research financing, but how to compare financing options. And this is called the APR. People don't understand what the APR is. It's called the annual percentage rate. People are fixed, and as they should be, on the interest rate itself. The interest rate itself is obviously very, very important. So if you take out a mortgage at 6.5 versus 7, that's hundreds of dollars a month. So the interest rate's obviously very important. Now, but how to compare loans is through this thing called an APR. Let's say you're talking to 3 different lenders, like I suggested, and they're all giving you an interest rate quote of 6.5%. Okay, they're all equal in that respect. Now, what the APR will do is to compare those 3 companies is to look at the APR, because if the rate's the same, well, what is the difference? The difference is going to be most likely the fees are going to charge you to get that rate. So the APR is a calculation of not only the interest rate itself, but the cost of getting the mortgage. So maybe one lender is charging you 2 discount points. A discount point is what they call a buy down fee. So they say, well, Mark, we'll do 6.5%, but we're going to charge you 2%. 2% of what? 2% of the loan amount. So if you borrow $400,000, that could be $8,000. That $8,000 is an extra charge that somebody who's not charging any discount points wouldn't have. So the APR on that for that lender is going to be much higher than it would be for somebody charging 6.5 or with, let's say, 1 point or no points. So the APR is a calculation you want to look at. It's sort of hidden. That's the other thing. Lenders, it's not hidden legally. It's just on the back page. You have to kind of do the research. The interest rate's up front, typically on these estimates, but the APR is on the 3rd page. So if you're looking at what they call loan estimates, make sure you go to the 3rd page and see exactly what you're paying for this loan. And it's basically a calculation of what you're paying in the first year, because you don't pay closing costs every year. You pay them one time up front. So it's a calculated estimate of the interest rate plus the closing costs. And these could be lender fees. They could be discount points. There's could be appraisal fees and certain title costs, mortgage insurance. These are all factors that go into the APR. And so bring that up to your loan officer as well, because a lot of times they're not going to discuss that point with you. They're going to say, well, our rate is really good at 6.5, but when you do the research, maybe they don't have the best deal. So keep that in mind as well. And so I want to talk a little bit more about, I want to kind of wrap it up is working with self-employed. If you're self-employed, and a lot of our clients are, It's not that much more complicated. There's just much more paperwork. I have a client now who's got 4 different businesses. So we have to get tax returns on all 4 of his businesses. There's much more detail and minutia if you're self-employed versus if you're a W-2 employee. So keep that in mind. There's alternative sources of money too for self-employeds if they don't have qualifiable income. Let's say you have a business and you write off a lot of expenses. You make money, but you don't show it. We can use bank statements and we can use other sources of income or verifications of income besides tax returns. So make sure that your loan officer knows all the different options if you're self-employed, if you own businesses, or if you're a partner in a business. Let's say you have a partnership with some friends and businesses and you get a K1. Okay, you don't get a W-2. You get distributions as profits, but you don't get a W-2 or pay stub. Those are all also different ways of being in business. So make sure your loan officer has done a lot of these in the past because it can get kind of complicated with underwriting. So I'm going to wrap this up. It's been a fun 26 minutes here with you guys. And again, if you have any questions, reach out. My number is 512-789-6967. See ya.